The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us. Great to welcome my co-host, Elliot Turner, and our special guest, Bill Chen of Rhizome Partners. Bill returns to talk real estate. The last few episodes we've done with Bill have been terrific. Lots of great feedback, lots of great learnings, and we have another terrific discussion ahead. Bill, I know you've been on the ground doing some due diligence in New Jersey. What's going on with that?
So I've been driving around New Jersey, zigzagging. I'm currently in Jersey City looking at some real estate, and what's interesting is what we do when we look at a company. We generally want to combine boots on the ground analysis, or what in our industry call the vibes analysis. How do you feel walking through a neighborhood, driving through a neighborhood, and spending time? And a lot of time, what we try to do is we try to have lunch, grab a coffee somewhere, kind of get a sense for what the nightlife is. And we combine that kind of analysis of trying to spend more than one day in a location to get a feel for the neighborhood. Why is it attractive? And we combine that analysis with all the data, right? All the data provided by the company, the occupancy rates, the rent growth, along with, a treasure trove of like other data that's available, income levels within a 1 mile radius, et cetera, et cetera. And I think that gives us a better sense of the attractiveness of the real estate that we invest in via the public markets. And what we generally find is that on the public side, a lot of times, a lot of the participants suffers a little bit too much from just, spreadsheet math and being holed up in an office, right? They're relying a little bit too much just purely on the numbers, and they're not out there on the ground. And we try to form strong opinions by being on the ground, and also by looking very carefully at the numbers, following the trends, following the operating performances. So I would encourage everyone who's listening to the podcast, if you are looking at a REIT or any sort of public traded company that owns large real estate exposure, to put some boots on the ground, to spend some time, because when you get a 30, 40, 50% drawdown in your position, it is a lot more comforting. You sleep a lot better at night, having spent time in the neighborhood and understanding and having conviction that those real estate will be, there'll be demand for the real estate that you own, right? Like, know what you own. So that's just a little bit of kind of me on a soapbox, really kind of preaching how important it is to put boots on the ground, in addition to all the other analysis that you would do. But I actually wanted to talk about one of the topics that we care a great deal about in our underwriting process, which is a premortem failure analysis. And I think that this is a topic that I care a lot about, because I had a background as an engineer, and I've been taught to think like an engineer and think about how something may fail ahead of time and how to prevent that. But also because of my experience during the great financial crisis working at Citigroup, when Citigroup itself almost have to file for bankruptcy. I was in the midst of all the different banks, all the too big to fail banks being all kind of tied up via CDS swaps that one party sold to another. So one party went under, there was this domino effect that they may all go under. and to kind of see it from the inside on the impact when the capital markets stops functioning. Now the REITs or the more private, a private piece of real estate, private GP, how they have to fend for themselves and the stress that it puts in their investments. And what I really want to go over is to kind of provide a framework for people to think about before you make a real estate investment. Understand one of like the handful key criterias on how you lose money in real estate. And I would go through 5 key criterias, and we could go into, we could discuss like any of them in detail once I go through them. The first criteria, in my opinion, is what I call the maturity risk, or the GGP risk, or the general growth risk. So this is a very famous example where General Growth did an acquisition before the GFC, and they took out a big chunky, I believe it was about $5 billion loan that just happened to mature in the GFC in 2009. And it just turns out that the capital markets were totally shot, right? So this was a time period when people thought that the banks were going to go under. You have Bear Stearns fail, Lehman, but it was bought out by JP Morgan, and then Lehman failed. Lehman was failed in the government let Lehman fail in like a true bankruptcy way, and had all this ripple effect, right? So when the loan came due for General Growth Properties, the capital markets was not there to refinance that $5 billion. And General Growth didn't have any problem servicing that debt. But the fact that they had a big balloon payment that came due, they were forced to file for bankruptcy due to liquidity issues, not because of solvency issues. So the first thing, if you're making a real estate investment, the first thing we always check is, when is the next, what is the schedule of debt maturity that are coming due? Are there any big chunky ones that are coming due in the next 24 months, right? Does a company on the REIT side, we always look at, is there any capacity on the revolver where the capital markets were closed? Could they just simply pull down on that revolver to pay off those maturing debt? That's a really, really critical analysis that we do. However, on the private side, if you're in a single asset deal, usually you won't have that luxury. You won't kind of have this corporate credit card. So always watch out for maturity risk when you make a real estate investment. The second one is, these concepts are very simple, but yet I keep seeing people repeat the same mistakes over and over again. The second mistakes that people make is the debt service ratio, right? And what I mean by this is, I talked about this before about, what is your interest payment? What is your fixed cost, right? Like, what is your combined interest and principal payment? And can you service that from the cash flow you generated from the piece of real estate that you own? And what is that ratio? Generally, on private multifamily deals, it needs to start at 1.25 times coverage ratio. On the public REIT side, they tend to be a lot higher than that. 2-3 times tend to be considered to be on the low side. Some of the lower, leverage companies are in the 6 to 8 times. All right. Always pay attention to leverage ratio. You don't ever want to get close to 1 times, because once it starts falling below that, you can't service that mortgage. Then you need, you may burn through some cash reserves. Once you burn through the cash reserves, that's when the banks come knocking, and you have to figure out what to do. That's when you get foreclosed upon, and that creates a chance that your equity is totally wiped out, right? The third risk is terminal risk. Now, sometimes I don't think anyone purposely go into an investing in a terminal asset class unless they're getting a 20% yield on that asset. Generally most people invest in assets and they find out at a later time that it's become a terminal asset class. This is a BNC indoor mall, BNC office today, and sometimes a big trend emerge, and an asset, an event like a pandemic and the rise of work from home makes the B and C offices obsolete almost overnight, right? And the fourth risk I would say would be overpaying. Now, overpaying is kind of tied to your debt service ratio. Obviously, if you pay too much, that will likely lead to you not being able to service your fixed costs very well. But there's a scenario where you probably could have bought, a multifamily in a Sunbelt at a 3.5% cap rate in 2021, but you could have fixed your debt so you could service that debt. That debt probably have very low interest rate on it. But when you go sell it in today's environment, you probably have to sell that at the 5.5 to 6% cap rate. So even though you could service the debt, but you could lose money because you overpay. You paid too much for that piece of property. The fifth one is just management, right? Like, on the public side, it's the corporate governance, the management quality of the public traded REIT or public traded real estate C corp, and time after time, I'm just reminded that the people you get in bed with are critically important, right? And I've had situations where I thought that something was worth 3-4 times as much, and then the management team just don't care, and they have control, and they'll never realize that value for you, right? Or you just allocate capital to people who are incompetent, or there are entities that are in the public markets where they are paid based on the number of assets they manage. So their incentive is to just manage as much asset as they can, and they don't care about the economic of buying the next building. They'll gladly overpay, which will lead to them, earning more management fees. There are certain entities out there like the RMR entities. So on the private side, it's actually harder to assess management quality or GP quality because you don't have a public track record of a public traded company where their capital allocation decisions are public, their compensations are public, the way that they capitalize the company is public. So I typically find it a lot harder to do due diligence on management quality on the private side, unless you know them for 5-10 years yourself, right? But on the public side, anyone could go back 5-10 years and look at the operational, execution, and also the capital allocation track record of a management team and their compensation to form you could quickly form an opinion, a pretty good opinion on the management quality. So I think those are the 5 key criterias that you should watch out for when you do a premortem analysis on to make sure you don't lose money when you invest in real estate. I'd love to open it up to you too. Yeah.
Yeah. I'm curious if you have any examples you could share, or tell us sort of in your experience, which of the 5 has been most crucial in the some of the investments you've made?
I would say that they are. I'm going to give an answer. Like Howard Marks will say, these are all the most important things, right? Howard Marks famously wrote the book, the most important. I think it's called The Most Important Things, right? And there's like 20 of them. I would say all 5 of them are equally important, and I think any one of them could potentially get you in a lot of trouble. I do think that if I have to pick one of them above anything else, I would probably say the maturity, because when you have a near-term maturity, that could trigger an event immediately, right? So that creates a catalyst for you to potentially realize, real impairment to your investments. There's been times where if we buy at a cheap enough price, and this is coming from a value investor, if you buy at a cheap enough price, you could have a bad management team. You could have, like if you buy at a cheap enough price, it kind of tends to solve for some of the leverage ratio issues, the fixed cost service ratios. if you buy cheap enough, sometimes that could kind of offset some of the management qualities. I mean, this is an age-old problem in value investing, right? Is that how cheap do you need to pay to compensate for a management team that is subpar or just not aligned with you, right? This is a topic that can go on for days and days. But I would say that the near term maturity is perhaps one of the most important. I would probably rank that as number one. And here's like a great example of like in real time, there were multifamily deals that were bought in 2021 at call it 3.5% cap rate. The GP sponsors kind of probably got 2 year debt terms that they have like 2 year maturity with maybe like 1 year options. It was like fixed for the first 2 years, where they have rate caps for the first 2 years. Now they're starting to float. Right now, the interest rates are going from fixed to floating, and they can't service the debt. Right. So I would say that from my personal experience, the near term maturity is perhaps the most important criteria. Now, everything, most of the things that we have bought, I say 95% of the investments that we've made, you know, don't the maturity of at least 3-4 years out. So we could almost go through a whole rate increasing cycle and then have it, potentially come down. So I would say maturity is probably the first and foremost that you should be looking at.
Let me ask you a question on the management side of things, because I think that is one of those areas where I try to wrap my head around this public versus private price disconnect. And when I think about a lot of the public REITs that I've looked at over time, and I can't say I've looked to the level of depth you have, but like as a contrarian, I look at 52-week lows, and there have been plenty of times doing this over a decade where you'll see a cluster of REITs, and a bunch of them, REITs didn't come to existence until, I'd say fairly recently compared to other kinds of companies. And a lot of the REITs have still, I guess, like either founders or people close to the founders running them.
Mm-hmm.
And
Mm-hmm.
they tend to have somewhat like dynastic, patriarchal org structures. And it's hard to tell if they're using the REIT to a degree to like maintain a lifestyle or something else. So like, maybe talk about that piece of management risk. Would you ever get involved in a REIT where it's like, the kid of the founders running it, and you don't necessarily know whether he was there because he earned the right, or it was, and I'm saying he because I think almost every case I've seen is that earned the right,
Mm-hmm.
or because fell into the right, or like, how do you think about some of those structures and questions?
Yeah, I mean that's Elliot. That's a fantastic question, and that is definitely something that we pay very, very close attention to. And kind of to what I said earlier, there's definitely a penalty and a premium for the corporate governance of a REIT, right? What I am willing to pay, my discounts get smaller if I believe that the management team's gonna do the right things and they're competent operators, right? And so I'll go through the different ranges of of like corporate governance, right? I mentioned the RMR entities and like there are certain entities out there that, for lack of a better word, like I just won't touch with a 10-foot pole, right? Like there's just like almost no price that's cheap enough for me to like get involved with it. Like maybe if they historically have traded at an 8-9% dividend yield, and now they trade at 15, and I'm like betting on a re-rate back to like a 9% dividend yield, right? Like that's a trade. That's not an investment. That's like a bet on some sort of like the market's already incorporating very, very bad governance, and and this yield is too high, right? That's not something I may do that trade, and size is small, right? So that's like one category, and there are entities out there that falls into that category. There are also categories where um, there's REITs or companies that own large real estate holdings that I was involved in a company years and years ago that where I thought a rational person who's going to run an auction on this will probably sell this portfolio for three times what it was trading at the time. But the family owned more than 50%, and they just didn't care. They just didn't care. Actually, one of the most bizarre, annual shareholder meetings that I went to was I went there and they held up one of the investment pieces that I created. And they're like, everything in here is false. Like this area is dire. It's, and I'm literally like, I'm kind of thinking my rent just went up something like 10, 15% year over year. And you're telling me so I've been in like bizarre situations like that where, and over time I've just learned that it's not worth the headache, right? Like it's just not worth the headache, especially in situations where you're not getting paid, like you're not getting paid to wait, you're not getting compensated as a shareholder in the form of a dividend. So when there is no yield, then I really, really don't want to get involved in that, right? Then you kind of move to like slightly a little bit better, like where we have been paid by the market is where we find a company, there's a large family ownership, and we actually do the work to talk to management team, map out their shareholder base, and understand their incentives and motives, right? So there's two companies that falls into this category where they had it was trading at a big discount to sum of the parts. And every time I spoke to someone, or every time I, talk with someone on a investment forum, they're like, well, the family owns a lot of the shares, like they're getting paid, like, what they think was too much. But like if you kind of use the lens of like how much would a private equity, like a Blackstone or KKR to charge to manage this, they were actually getting paid a lot less than professional private equity sponsors, and they were actually doing really good. They were making, they're good operators, and they were making fantastic capital allocation decisions. Those are the situations where if you have an informed opinion and you're just digging deeper, those are situations that we love, where over time, the narrative, and you can kind of see it shift, right? The narrative goes from, the, like there was a company where they have gone through the trouble of spinning off like a non-core business that was like making the financials very messy, and they went through that trouble, and in that process they also kind of remove a lot of liability from the parent company to the spinco. So but like when I talk to people will say, well, they said that they wanted to like reduce costs, but now they're like managing both companies. And I'm kind of like, well, if you talk to management team, like they did this to highlight the value in the real estate rather than the operating business that was 80% revenue but only 20% of value, right? So those are situations where if we have a differing opinion than the market, it doesn't, the re-rate doesn't happen overnight. Generally it takes like 2-3 years, but eventually the market like comes around and agree with us, right? And there's also situations like that where they just don't care, like and we probably, if there is no dividend and there is no way to unlock value, we probably won't want to get involved in those. And especially in today's environment where a lot of the big blue chip pure play REITs with great balance sheets and great assets are paying you at least 4% dividend to sit and wait. Uh, we rather own the larger, more liquid names, right? And then like you kind of get into kind of categories where like you keep moving up on the quality curve, right? Management quality curve, where you get great operators who do everything right, and it's a pure play, and people just don't appreciate them for the good work that they do. I mean, those are the investments that we absolutely love, right? Like, I think we found a few of them in recent, in the past year or two, where they're being punished by the market because of like very short term, where they're experiencing a little bit of tailwind for the next 6 to 12, 18 months, right? But we'll come out the other side much better. So there's a spectrum. There's a range of this management quality, and we're gonna need really really large discounts for me to get involved. Like on the companies where the management team, it's really like it's a hobby for them to run these businesses, and they don't care about outside shareholders. To the ones where they're paying you a nice dividend, the asset, the portfolio trading at a big discount, and they're actually really good capital allocators, but maybe there's like a temporary vacancy in a couple of their assets, and the market's like already punishing them for it. Those we absolutely love. Elliot, I don't know if that adequately answers your question.
That does, and I think that's very fair. We did discuss management before, but I figured it was important to kind of touch on it in light of these risks. And then, I kind of want to touch on one of the things, and then I feel like it probably hits in more than one of these 5 ways to lose, but I don't necessarily view it as a way to lose. It's like a different kind of risk, because a lot of what you've talked about is seeing this opportunity for like double-digit IRRs in real estate investing over the course of, a mid to long-term time horizon. And part of that seems to be this convergence of um, the public REITs are trading at a steep discount to private market values. But like, how do you think about the risk that perhaps the convergence is that private market values are too high and they drop down to public market REITs, or that rates end up going higher, and so cap rates have even more room to rise? And so maybe you're not necessarily losing money, right? It's not a way to lose, but that at the end of the day, your terminal value is just going to be like, maybe it's exactly what it is now, or maybe a little lower, maybe a little higher, but not in a meaningful way that actually matters. So the returns are, lower than what you'd say your cost of capital actually is.
Yeah, no, man, that's a great question, and this is where in investing there is no guarantee, right? There's only a range of probable outcomes, and this is something that my analyst and I, and a lot of investor and I have kind of conversed about. And what we try to do is that we try to pinpoint the moment where, at what kind of exit cap rate and what kind of rent growth levels, like, do we start to experience a 0% IR, right? We start stress testing that. And on the multifamily side, on the big multifamily REITs where we've done the most amount of work on that end, like, you need cap rates to kind of go into like, I think the high sevens, 8% cap rate in order for you, and because like when you own a piece of cash flowing property, you are receiving dividends and distribution, and over time you are going to grow rent, right? It may not grow 5, 6, 10% a year like they did during, immediately during the post COVID, but like generally it's safe to kind of bake in 2 to 3% rent growth, at a conservative level over a long time period, right? So we run a lot of the analysis, and even we go into a higher interest rate environment, and I think where the REITs are trading at today around 6.3, 6.4% cap rate. I think like if you hold it for a full, call it like a 3-4 year period, for you to have a 0% IR on it, like you really need the exit cap rate, like for the market cap rate to be in the high sevens to like, low eights for you to like start actually having a 0% IR. And from an investing perspective, right? And then like you kind of take that back and you say, okay, what is that on a per unit basis? What is that on a replacement cost perspective, right? You would you look at like, can the industry actually add any supply in that kind of environment where apartments sell at an 8% cap rate? Like what we do know today is at a 5% cap rate, the industry, given today's interest rate environment, can't build any more supply. Like the supply pipeline has completely kind of collapsed, right? They're not putting new shovels in the ground. So, you know, there's no guarantees investing, but there are a range of probable outcomes. And in our opinion, the most probable outcome is that if you don't build any supply, your rent is probably going to grow fairly rapidly. It gives you pricing power, and like, are we okay with like having a 0% IRR if the market goes to an 8% cap rate? I think that's a risk that we're willing to take, right? And so it's like I think you gauge the probability of the world ending up that way in that kind of cap rate, which will probably means that the market value is going to trade at something like 40-50% of replacement value. And you kind of have to ask yourself, like, is that realistic? And we have a strong opinion that that's not realistic. And I think, the investors that, ask us to manage capital for them are willing, like they understand that that's the risk reward, right? For them to kind of have a 0% IR, we're talking about the market cap rate going to around an 8% cap rate.
I just want to think about this replacement value point a little bit, but like, can't that get a bit recursive at a certain point where, like, the way to solve that problem might not be constructive from a financial perspective. It might just mean that things don't get built for a very long time.
Recursive meaning, I mean, things don't get built for a really long time.
Right. Rather than it being like a financial reality that you could somehow realize what replacement value is truly worth.
Yeah, so there definitely is a world where nothing really gets built for a really long time, right? But maybe assets still trade at really cheap prices, is kind of what you're saying, right? Like,
Exactly.
and I think that's possible, right? That's like possible, and I think this is where the public REITs, because they have access to cheaper capital today, right? If you think about why we want to be on the public REIT side, let's kind of think this through. Mid America and Camden both just issue 10-year fixed rate debt at 4.95% cap rate, right? I mean, in a world where if they could get that kind of financing, which they're getting today, right? And they could go out, issue debt, and buy assets at an 8% cap rate. I would say turn off the dividends and keep do that all day. Take the cash flow. I don't need the dividend, right? Take that cash flow and just go buy 8% cap rate assets all day. And this is where the difference between the private and the publics kind of divert, right? Like, if you're in a syndicate deal, you're in a single deal, single asset, you probably don't have the ability and the optionality to like redirect that capital to if you're in a single deal, you kind of can't buy 5% of another building on the private side. Also on the public side, there's a portfolio of hundreds of these buildings, and you could take a $500 million of cash flow a year and get yourself $40 million of net operating income because you're buying at an 8% cap rate. And that, in my opinion, is going to create a lot of value, especially if your debt financing cost is 5% in that environment, which is exactly what they issued debt at earlier this year.
I'm curious, what are the largest buybacks you know of in the REIT space right now?
the largest buyback, I know that, and thank you for bringing that up. So I've been in the public space for over a decade. This is probably the most amount of REIT buybacks that I've seen. REITs, are animals that typically issue equity. They usually don't buy back shares, right? This is the first time that I've seen companies just buying back shares left and right. I mean, I can name two that Camden, which is a multifamily REIT, they're buying back shares. Really anything. And the president have told me that outside of any the dividends and maintenance capex, they don't have any plans right now because just very, very rationally, if they could buy back their own shares at the time we were talking at 150 basis point higher than anything they could buy in the private market, why buy the private deal when they could buy their own portfolio that they know really, really well? So they're buying back shares. I mean, they're probably at like a 2 to 3% annual buyback rate. And then Next Point has been selling assets. Next Point is probably the best. They've historically has always been periods when they believe they're overvalued relative to private market. They would issue equity to go buy private deals, and when they have when they trade at a discount, they've been willing to sell assets and use the proceeds to buy back shares. So those are the two that I know of. I'm probably sitting in the car doing the podcast, so my mind's going blank a little bit. But this is the most amount of share buybacks in the REIT space that I've seen, and these are not vehicles that are meant to be buyback machines. They're really meant to be net equity issuers.
Yeah, it gets back to what you've said about management too. Like you need management. Like part of why they've never been repurchasers in this space is you get paid more when you manage a bigger portfolio. So like why ever shrink when growth means more comp?
Yes, that's a great point. And I think there's more flexibility if you are already up subscale, or if you're already at scale versus when you're subscale, right? Like one of the traps, but that this is one of the themes that came out of NAREIT, which we kind of talked about in the last podcast, which is what were REIT CEOs concerned about at NAREIT. And I would say like they weren't concerned about access to the debt capital markets. They weren't concerned about really anything operationally. There's a couple of them that are in the middle of a being targeted by activists, right? So they're obviously concerned about that. But a lot of them that are in that $1 to $2 billion market cap range, they're they're seriously concerned about being subscale, right? There's a certain minimum cost of being public, and they want to be able to have enough of an asset base to absorb and spread all that fixed costs, corporate costs over that asset base, right? And sometimes that could kind of, in my opinion, lead to suboptimal decision making, where they may acquire assets even though it's not accretive because they need to scale that public company costs. But again, like if you are $3 billion in market cap and above, and you have the balance sheet, your net debt is below 6 times net debt to EBITDA. I think a lot of them have a lot of flexibility to take the leverage job. I mean, we even openly push for one of the REITs to take the leverage from kind of mid to high 3s to 5 times to buy back shares. Now they don't want to go up to 6 times because they'll get punished by what is called the REIT mafia, right? There's a group of investors that kind of dictates kind of what is normal and what is considered conservatively levered and what is considered highly levered. And if you go above some of those metrics, you get punished, right? So so I think the larger, more liquid REITs with a healthy balance sheet, they're using this as an opportunity to buy back shares.
Sorry, who is this REIT mafia? All these episodes, it hasn't come up yet. I want to hear more about this REIT mafia.
Okay, so the REIT mafia is a nomenclature that we use, and we're not a part of the REIT mafia, right? The REIT mafia are think about your Cohen and Steers and Nuveen and dedicated REIT buy side investors, not Bill Chen, opportunistic public real estate investor. They manage a lot of capital, and they since the GFC they've kind of told management team, hey, if you are above 6 times net debt to, 6 times net debt to EBITDA ratio, we're going to penalize you. You're by not owning your shares, and then your equity cost of capital is higher. They don't like complexity. They'll basically punish companies that have a large development pipeline. If you're not liquid enough, you get punished, right? So this is why a lot of REITs, there aren't a lot of diversified REITs. If you're in too many lines of real estate sub asset classes, if you own multifamily and you own office, you tend to get punished. You tend to trade at a bigger discount to liquidation value. So what winds up happening is that a lot of REITs try to accommodate the REIT mafia and become, a pure play REIT with, net debt to EBITDA ratios below 6 times. And anytime there's some sort of like near term headwind, which would be totally fine over like a 3-year holding period. If there is, this is a great example in the Sun Belt. There were a very large amount of supply being delivered, and the REIT mafias don't want to own that exposure, right? Like we've seen the REIT mafia investors go from all about owning Sunbelt multifamily to not wanting any of that exposure to, wanting to kind of hide out and be safe in the coastal REITs. And we, our investors tend to view things over a 3-4 year time frame. And when we invest, we generally try to, generate healthy double-digit returns for them. And if there's some near-term headwind, like we think like real owners, right? And a lot of REIT mafias, they have certain benchmarks that benchmark on a quarterly, on an annual basis. And when you think about like where does the structural outperformance come from, some of that is behavioral, right? Like if you're tied to these short-term benchmarks, then that's what you worry about. Even if you could get an opportunity to invest in something where you could double your money over 3-4 years, you may not do that because you may trail behind your benchmark for the year or for the quarter. It's very important to understand like who the other market participants are.
Are there any really good analysts or even some activists who you follow and look to see what they're looking at and speak about in the space?
I think there's definitely very. I'll probably have to think that through and I think obviously like when Sam Zell was alive, like anything Sam did was really interesting. Um, that's probably a better topic for the next time we have the podcast.
You got it. So maybe, in these closing moments on the podcast, would love to hear about any spaces outside of the real estate space that you're finding to be interesting and worth your time nowadays.
Yeah, I mean, I think like we think that there's generally a theme of companies that clearly over earned during COVID that is taking time, and I know that the MOI podcast have talked a lot about the over earning dynamic and kind of the the whipsaw effect, right, of COVID in the inventory build and then the spike in demand and the demand collapse. I think there's still a lot of companies out there that over earned during COVID and they maybe responded incorrectly with adding a lot of supply. And this isn't just, one industry player. This is kind of all the industry players did that, right? And I think that they've been punished. And I think that a lot of them are still being overly punished. But I think we have trough on the downside in terms of the demand collapsing. I think the demand have trough and we're starting to inflect and starting to come back, to growth again. Modest Proposal from Twitter did a podcast with Patrick O'Shanahy talking about the commoditization of AI, which is a really good podcast. I highly recommend everyone listening to that. But one of the things that was really interesting was that he mentioned about the aluminum beverage cans, right? Where the industry as a whole kind of bought into, like think about the setup where everyone's stuck at home, no one could kind of go out to bars, so people are buying a lot of canned soda, canned drinks, canned beer, and the industry grew at high single digits as a result, which is not a normal growth rate for consumer products. And so the industry responded by adding a lot of supply, and they're absolutely being punished right now. All the stocks are being punished. This is Ball, Crown, All Dark Metal Packaging. That's a nice little oligopoly. And if anything, now they're taking supply out of the industry. And I think a lot of the earnings have troughed and they're starting to grow again. So you kind of have this setup where the supply is leaving the industry. Everyone is terrified of adding supply to the industry. If anything, there's like a lot of hidden earnings power where they don't need to invest the capital. There's the ability to earn a lot more as the demand grows over time. But no one want to own any of these exposures. So the aluminum beverage can is just an example of this. But I think generally any and again that's a being real estate investors, we're generally kind of investing in fairly commoditized assets. But we just pay a lot of attention to supply demand imbalances and what kind of price are you paying for these businesses. I think aluminum cans are particularly interesting right now, and just small cap value in general. I mean, it sounds like a broken record at this point. A lot of value investors have been kind of complaining about small cap value. On one hand, you got Chipotle, Wingstop, and Costco trading at 50, even over 100 times PE. They're really high quality companies growing really fast. And although the Chipotles and Wingstops have kind of come off recently this week, it seems like they're correcting a little bit. But the divergence between kind of the small cap value and these Nifty 50 type, the modern day Nifty 50 type, I think that contrast is super interesting, right? If you run a DCF on these, we believe the small cap value are super interesting. With aluminum can packaging being like one of the prime examples.
Yeah, in some ways that story rhymes with Sunbelt multifamily, where low rates and accelerated migration during COVID. It was a good story before then, but got really fast during COVID. Lead to a big supply response, and then it's oh, we got to absorb this all. And it's definitely a trend I'm looking for in other spaces myself, like the life sciences is one where I've been especially keyed in on the excesses of COVID turned to opportunity on the other side.
Absolutely. I mean, we've gotten involved a little bit in the CDMO space. Been super fascinated. We're definitely a generalist, but not a specialist. But there's a lot of similarities between building all that. It takes 3-4 years to build supply, and the switching cost is very, very high in CDMOs. And so the companies have spent the time and the money building the supply. Now they got to ramp, right? There's an analogy like you built a multifamily building. Now you got to put people in the bed. You got to put heads in the bed. You got to ramp up that cash flow. And where the stocks used to trade double, triple, four times where it's trading at today, but you're like 2 years closer to stabilization. You spent the money, yet the stock is a lot lower. I mean, those are some of the CDMOs I think are really really interesting. I'm definitely a generalist there, um, and so we're finding a lot to do out there in this environment.
Yeah, it's interesting. If I could sum up the ideas that you flock to, it's definitely like these capital cycle kind of ideas. CDMOs are super similar to what you described in canning and in multifamily, right?
Yeah,
But they
yeah.
are CDMOs are also very much an asset where you could think about the replacement value, and you see that happening with Novo Nordisk purchase of Catalent. It's like we could either build this fill finish ourselves, and it will take
Hmm.
us 3 years and cost X dollars, or we could just
Yep.
buy this whole company, sell off the parts we don't want, and end up with what we need immediately for a lower price. Like, what are we going to do? And
Hmm.
there it's at least very clear that there are strategic needs that certain companies could fill, and they'd know dollar for dollar exactly what it would cost to, like, these things don't depreciate too quickly, so they know dollar for
Hmm.
dollar what it would take to kind of replace the building out of the clean rooms and filling it all with the instrumentation that they need.
Yeah, no, it's super fascinating. There's and I would say that it's a lot easier for a multifamily tenant to move from one apartment to another. For a customer to move from one CDMO to another is a lot harder. The switching cost is a lot
Yes,
higher, right? And
really good point.
I've been I've been really shocked at the multiple, even in a higher interest rate environment. There were a couple of deals that were done in 2023. The EBITDA multiple on some of these CDMOs are still absolutely astounding, right? Because if you invert that EBITDA yield, a lot of times it's actually lower than the cost of debt, the cost of debt financing on a lot of these deals, which really made me like scratch my head and kind of say like, why is that, right? And like there's a certain characteristic of that cash flow where it's very bond like. It's very that high switching cost really does a lot. So again, like I am a generalist, and this is, I think, when it comes to CDMO space, that's where a general it gets it gets so the companies get so sold off that it starts making sense for a generalist to underwrite. And I want to leave this podcast with a suggestion that sometimes when I get really frustrated investing in real estate, when it gets so frustrating to me that I start getting generalists poking around in a name, that's a sign, right? That's a sign that it's gotten so cheap. Now a non-real estate investor is willing to kind of risk their non-industry knowledge to poke around it, whether it's in office or in indoor malls, right? So I just want to leave that with our listeners, that if you're investing in your own preferred asset class you have a lot of knowledge in, and it gets so pessimistic, so depressed that people from outside of your industry start poking around because they think that it's gotten so cheap. Pay attention. That's a really really important signal, because that's usually a sign that value investors, with very very high cost of capital, very high underwriting, cost of capital, are looking around, and they could potentially be the people who may start the bidding up these asset prices. I just want to leave our listeners with that little piece of knowledge I picked up over years of investing.
That's terrific. Well, Bill, thank you so much. Elliot, as well. It's been a great discussion. Really appreciate it. I hope everyone listening got some good wisdom and insights out of this one as well. And we look forward to reconvening in the future. Goodbye, everybody, for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.